raise an issue.
Hey, Maria, can I throw in?
I want to ask you a question, but go ahead, John.
Well, you know, Maria asked about 2016. I think what we've got to be looking out for in 2016 is bubbles. You know, let's not forget the housing bubble that happened last time took place during a Fed rate increase cycle from 2004 to 2006. The Fed was raising interest rates,
right,
and we got a housing bubble. You know, I think we're seeing a lot of frothiness in commercial real estate. We're talking about stocks ripping. Interest rates are still very low. I think we're going to be talking a lot about asset price frothiness next year.
That's the Fiscal Times broke down what the interest rate increase means for your money, and we talked a little about the banks, but I just want to get to this because this is really interesting what the Fiscal Times did. Health premiums expected to rise 4.1%, groceries 2 to 3%. Take a look at the graphic that we have. Even dinner out should jump 3%. So you have all of these costs that are expected to move up in 2016. One of the reasons that people are not spending money is because of the cost of health care. Let's face it, they saved at the gas pump, as Dagan has correctly pointed out over and over again, but they had more expense when it comes to their health care.
That's the reason to hike, though. That's inflation.
Right.
We talk about the decline in oil prices, but then you have inflation across these parts of the economy. That would be in the camp of the reason that they moved up.
Right.
And, John, I just want to point this out really quickly. That it's something that privately I was speaking to people last night. They're concerned about the mechanisms that the Federal Reserve will be using to actually get the rate up, to drain money, to set a floor for rates and to basically control the movement in interest rates. They're worried about the impact it's going to have on the banks and on the banks' lending, because we just don't know. These are uncharted waters.
Yeah. They're using a whole new set of tools, and I think it wouldn't be surprising to see some volatility of short-term interest rates at least in the first few weeks, and especially as we get into year-end. They say they're confident that these things will work, but the truth is they've never used them. Can I say one other?
John, I got to ask you one other thing. She also gave a comment yesterday, Ms. Yellen, about the Third Avenue Fund and why she said it was a one-off. A week ago and earlier this week, many people in the industry were deeply concerned that there are similar funds, not holding all the same toxic paper, but there's a real concern about this high yield market and the freeze.
Yeah.
She said it was a one-off. Should viewers of this program who own these funds say, okay, the Fed Reserve said that we shouldn't be worried about any other funds putting up gates and locking us out?
The fact that Janet Yellen was prepared to give such a specific and detailed answer about Third Avenue tells you the Fed is very concerned about what's going on in the junk bond market and about what's going on in junk bond funds and junk bond ETFs. So, you know, she played it down. The SEC is looking at it, but the Fed is very concerned about this being an area where we could see runs.
This is really important.
I want to say one thing.
Third Avenue, they shut the gates. People were not able to get any money. And we should point out, that wasn't anything exotic. That's a mutual fund. Right. Third Avenue Capital that closed its funds. I mean, the mutual fund. So do you worry that the credit funds out there are going to see more blow-ups and that's going to rip through markets?
We discussed this very topic at our policy meeting yesterday. Our junk bond guru, Mark Durbiano, made the same conclusion. We've studied what's in their portfolio. This is a one-off. This is low-quality distressed stuff. And he said, he and Steve Auth, our CIO, said, we would hope that Janet Yellen will address this topic specifically.
Phil, why do I hear you say that, and I'm sure you feel the same, Maria, that I remember people in 2007 say that the Bear Stearns hedge funds were one-off funds. When those funds collapsed in the summer of 2007, it was a one-off.
Look,
a fair point. The four most dangerous words in the English language are this time it's different.
I can tell you why it's contained, because people, it gets down to people are betting on oil not falling, and they bought and they levered up to bet on that or to invest in oil. So they assume that oil wouldn't fall. Oil is not it's not the same thing as housing. It doesn't hit mom and pop. It's not as widespread. Will it hurt? Yes. Will it be the catastrophe? Because a lot of this oil leverage is not in the banking system. A lot of these junk bonds, it's not in the banking system. We're not going to have a bank bailout.
It's in the energy space.
Right. That's why it's more.
What do you want wanna
in the
own.
funds that a lot of the individual investors own.
Not that many.
Well, they own a lot of these high-yield credits.
They own a lot of high-yield credits.
You like stocks, and
yeah.
you're happy about the economic sort of story going into 2016.
So we like the stocks that are economically sensitive.
Okay.
And I think there's an important point that we haven't discussed here, that some of the inflation metrics, not just core PCE that Yellen's looking at, unit labor cost, the employment cost index, wages, et cetera, have been ticking up. And the one thing we've got to remember is that the utilization of monetary policy to adjust the economy is not, it's like turning a battleship in the ocean.
Right.
All right? It takes 6 to 9 months for 1/2 of the effect of a rate change to hit the economy. It takes 12 to 18 months for the full effect to be felt. So what the Fed is doing today is really not going to have a material effect until we get into like mid-17. The Fed's got to be making this change now in anticipation of what they think is going to happen 18 months from now.
All right, we'll see about that. Phil, good to have you on the program
Thanks for
today.
having me.
John Hilsrenrath, always a pleasure. Thank you, sir.
Thanks a lot.
We'll see you soon. John, Phil Orlando, we will see you soon as well.